current asset minus current liability. So you have to make investment in here, working capital. So expense is to hold inventory, because any asset if you hold, there is an expenses. So expense is related to carrying your working capital. Either you are paying interest, either you are taking credit, so there is imputed cost of holding material. So these costs are costs related to working capital. Or very simply, if you take working capital loan from the bank, you have to pay interest to them, or you are taking purchase on credit, you are paying higher charges, or your own capital is invested. So working capital requires the cost. Terminal cash flow, annual cash flow plus working capital released. So over a period of time, it is possible that your current asset minus current liability decrease over a period of time, so you get money. So in the cash flow statement also we have studied it, that if working capital increase, it means your current asset is higher, it means there is a cash outflow. Similarly, if working capital is reduced over a period of time, there is a inflow of the cash plus scrap value of the machine. Now these are the decision criteria. Either it may be traditional, which ignore the interest and inflation. Say for example, payback period. It is very simple. Say for example, there is a total investment of 1000 rupees. If your net cash flow in the first year is 1000, second year it is 2000, third year it is 3000, then there is a expenses. We assume 800, 600 and 2400. So net cash flow is 200, 400, 600. So after second year, you cross 1000, your payback period. So it is 2 year plus something, or we can say it is between 2 and third year, your 1000 rupees will be recovered. So this ignore the interest rate. Accounting rate of return. Then time adjusted or discounted cash flow are the net present value. They take into care the time value of money. So money received today compared to money received tomorrow, there is a higher value. Say for example, in this case, you receive 200 rupees this year. This is on the second year, this is on the third year. So this value you will take 200 rupees, but 400 will be multiplied by the interest rate. Say for example, it will come to 360 rupees, or this will come to the next year again. So it will be 480 rupees, because we have to multiply by the factors. Then profitability index. Profitability index in this case will be 400 rupees per year, or internal rate of return. It is very complicated to calculate. Payback period is defined as the number of years required. So here it is 2 point something for the proposal's cumulative cash flow to equal the cash outflow. So after 2 years, between some time you recover 1000 rupees. The payback period is the length of time required to recover the initial cost of the project, which ignore the interest. The payback period may be suitable if the firm has limited funds available and has no ability or willingness to raise additional funds. The accounting rate of return may be defined as the annualized net income earned on the average funds invested in the project. Question from Praveen. Cannot understand the example. I will repeat. So your purchase of machine 1000 rupees in the first year. So there is outflow. We write it into bracket. In the first year, we have a net cash of rupees 200. Our revenue 1000 minus 800 rupees expenses. This we assume. Second year there is no outflow. There is inflow 400 rupees. In third year it is 600. So when we recover 1000 rupees, it is after 2 years, but before 6 years. So between these two periods, this is payback period. We assume 2.5. But it ignore the interest we have to pay. So if you apply the discount rate in the first year you get 200 is 200 rupees, but the 200 you get next year is less than 200 rupees. So you have to multiply 400 by, say for example, there is a 10% interest, 90, and in 600 it will be again less, it will be less than 80 in fact. So this ignore interest. So according to this you will recover by 2.5. But if you look at this figure, because of interest value of money, you will not be able to even recover after 3 years. This is 1200. So accounting rate of return is average annual profit after tax divided by average investment in the project. So ARR is concerned with the return with reference to what is the total investment in the project. Then discounted cash flow time adjusted techniques. We have given the example of net present value. These are based upon the fact that the cash flow occurring at different point of time are not having same economic worth, because the purchasing price of money goes down as the time passes due to inflation. The NPV of an investment proposal may be defined as the sum of the present value of all the cash inflow. So even though we receive 1 year after, what shall be the present value of this money? That is less than 400 rupees. The decision rule is accept the proposal if NPV is positive and the reject if the proposal is negative. So if we do not receive the required amount, then it will be ignored. So project will be selected on the basis of whether NPV is positive or negative. Profitability index is the reverse of payback period. This technique is variant of the NPV technique and is also known as benefit cost ratio or present value index. Total present value of the cash inflow 1200 divided by total present value of the cash outflow. Accept the project if the PI is more than 1 and reject the proposal if the PI is less than 1. Internal rate of return is a complicated process. It is defined as the discount rate which produces zero NPV. The IRR is the discount rate which will equate the present value of cash inflow with the present value of the cash outflow. The IRR is also known as marginal rate of return or time adjusted rate of return. So when NPV becomes 0, at which point of time, which rate of interest, the IRR is determined. The time schedule of occurrence of future cash flow is known, but the rate of discount is not known, because more particularly in this